Everybody, this is a webinar on earning 7% cash flow tax-free and our little bit of strategy on tax planning. So my name is Mike Angelo. I'm joined by Michael Wagman, my co-host. He's going to be a little bit under the weather, so he's going to have his camera off, but we're going to jump right in. And thank you for being here. We're going to go through it. If you have questions or comments, please use the chat function there. We've enabled it. Michael will monitor that and we'll answer questions right at the end. Typically this is going to be like 25 minutes and we'll go through any Q&A towards the end. So a pretty quick informational session. And again, thank you for being here. Let's jump in. So a couple things before we jump in completely. Just a disclaimer, this information is confidential, is also not tax advice. So while we are presenting this as educational, it is not investment or tax advice. We'd always consider having you consult with a tax professional, a business professional on any of these specific things. So we're going to talk a lot about taxes. And so again, every investor has a different tax scenario. So just make sure you read through that disclaimer. So here's what the evening looks like. We're going to talk through the basics of depreciation, cost segregation. What are the benefits? How does that apply to you? Is it a use it or lose it scenario? That's an important piece. And then the pending changes, right? We have a new administration in place, are going to be in place soon, and there's some implications, good, definitely for this particular topic that I think we're excited about as operators. So we'll talk a little bit about that. Let's jump in. This is our team. Again, Mike Angelo, Michael Wagman. We have been Nimble Capital now for the last 5 years. We have about 663 units under management across 4 states. We also have a large development side that we're working on a couple different projects. So about 80 million in assets under management. This is primarily value add multifamily, and then about another 70 million or so in development, multifamily and other residential. So we're an LP and quite a few deals. So starting off on the limited partner side, moving into the active GP side, and then just large background from business planning. And Michael has a lot of experience in the residential world of real estate investments and fixing distressed properties. So we bring you this information as educational. We are by far not experts. We don't claim to be experts. We're sharing what we've gone through and what we've experienced and sharing that information with you. Just a quick overview of our portfolio. You can see it's primarily multifamily, Class B, Class C, 1970s, 1980s assets across Arizona, New Mexico, Texas, and Oklahoma. And so we've been blessed to be able to manage these properties and really improve the communities that we serve and those tenants that we serve in there. And so again, if you guys have any questions on what we're doing, how we're doing on any of these, please don't hesitate to reach out. All right, let's jump in here. So the first thing, right? You're all attending this going, how do you earn 7% tax-free? That's crazy. Well, basically the way we're doing it is if you invest in a multifamily project, there are typically 2 components in that. There's a cash flow component, and then there's an equity component. So if you buy, again, we buy existing multifamily, as you guys just saw. Our goal is to get the property to a position where it's cash flowing, positive cash flowing. So we pay all the bills, we pay the debt service. What's left over is for the investors. So as operators in the syndication space, where for those of you that may not be familiar with syndication, we pool our funds together. So we, the general partners, find the deal, we put equity into the project, we partner with investors like yourself, we all collectively take the benefits. And so we pay out a cash flow once all those bills are paid, targeting between 5 and 7%. That's an annualized number. And you can see at the bottom there, if you put 100,000 into a deal, that'll pay about 7,000 annually. We typically send those out on a quarterly basis. If you go 250 to 500, you can kind of see the impact. So it becomes pretty significant. Well, that's great. But just like a dividend in stock, you can earn those as well. And sometimes you can earn 2, 3, 5% as well, but that's taxed. So how are we doing this tax-free? Well, it's tax sheltered is an important statement. And we're going to show you guys over the next couple slides what that means and how that works. So it's an exciting piece because if you invest large enough, there's a very good chance that you can earn all of these returns annually without having to pay any taxes. So think about if you're earning 7% and you're not paying your 20 or 25% typical tax bracket, that's really like earning 9 to 10%. So it's pretty substantial. In addition, when you invest in a multifamily project, you're going to have equity on the backside. We traditionally like to hold these assets for 4 to 5 years. So then we'll sell it. And so along the way, you'll earn that cash flow. And then on the backside, you'll earn equity. And it's all pro rata based on your investment number. So it's a great way to invest in a physical asset. Our goal is always to preserve your capital. And, in the long run, real estate has appreciated, whether it's at a smaller pace or a larger pace, but it typically has appreciated over time. And so whatever you buy today, if you can hold on to it, most likely 4, 5, 6 years from now, it will be worth more. So you get the appreciation and you get cash flow and you're owning a physical asset. So good stuff there. All right, let's jump in. Depreciation, what is it? Essentially, it's just an accounting method in how we can allocate the useful life of an asset. What does that mean to you? It sounds like a fancy language there, really. But if you look on the left, the government, the IRS, allows us to take a decrease in value and use it as a loss across different types of assets. So residential, commercial, land, etc. Right? Most of the time, you can't do much on land itself, raw land. You cannot actually depreciate land, but land improvements. So if you do things like sidewalks, curb and gutter, underground, those things are depreciated. You're allowed to depreciate those. We're going to focus on furniture and fixtures and like a commercial property, like a multifamily apartment complex. So what all of that means is essentially you have your income in a building or in a business, you have your expenses, you typically have debt service, and then you have some pile of cash that you made in the property. Well, this depreciation basically is a phantom expense and it allows you to take a loss on paper. So let's say you made $50,000 in net income. This 50K potential depreciation would reduce that to zero. So now your taxable income is close to zero or sometimes negative or just a much smaller number, right? So it's a great way to reduce your tax liability. That's really the whole point. What we're going to talk through now is bonus depreciation, which is a next level of depreciation. So we'll talk through that. Michael, if you're managing the chat, if anyone's got questions along the way, keep me posted. You feel free to stop me here. But all right, so what is it, right? Essentially, cost segregation is the formal term. We call it bonus depreciation because that's what is kind of known in the streets. But cost segregation is the tool, and essentially it accelerates depreciation. So we take normally a building or a piece of property and we divide it out by its useful life. And depending on the kind of asset, so most residential properties are 27 years, commercial is 39 years. You guys will see an example here in a few minutes, but we partner, and there's several companies out there that go out and do a study. They do an engineered study called a cost segregation study. And there's a sample of a report here, and they will break down a line by line item. They'll go, hey, when did you buy it? What did you buy it for? And what are the values of things like cabinets, carpet, paint, fixtures, sidewalks, roofs, etc. And they'll assign specific lifelines to it or timelines to those assets and be able to depreciate those possibly faster. So the whole point is accelerating it. Instead of taking it across 27 years, we might be able to take some of it in 5 years, 15 years, and 7 years, 5, 7, and 15-year buckets. Where did all this come from? Well, all this came from when President Trump was in office last time. He introduced a bill called the Job Tax Cuts and Jobs Act of 2017. That introduced this specific bill around tax savings. It's set to expire. I'm going to talk through that at the end of 2026. There's a step down schedule that's in place. Now that he is back in office, there's a high probability that that will come back. It is also a decision that will be determined at the Senate, and the Senate race is still out there. So, but there's a lot of folks on both sides of the aisle that are very much pro this tax cut piece because it is substantial. And there's lots of other components within that bill, right, within the act. But this is highly exciting for operators like us and investors like yourself. If you're looking to get into a deal and looking for tax shelter, this is a phenomenal tool. And basically, it's going to get better. That's really the goal. So, all right. So I kind of described what it was. Essentially, we take the depreciation, we increase the timeline. That means less taxes, which means more cash flow for you. That's really, at the end of the day, that's what this means. Let's talk through some of the mechanics. So focus your eyeballs on the top of the chart here. We're going to use a property that we bought. It's a multifamily property. We bought it for 2.9 million, right? So we're going to look at it, and what the government does, it says, again, you can't depreciate land. And so we separate the value of the land, and that's typically an assessed value. So you can see there on the right, 833,000 gets pulled out. So that leaves us a little over $2 million. We're going to take that and we're going to divide that by 27. It's about $75,000 per year. So that's what we can depreciate on a typical building. So if you do that, 75,000, we can write that off immediately, right? Without any kind of additional work. That's the free process. Your accountant / CPA can go through and do that. But if we want to accelerate some of those items, we go out and do a study. And that study isn't free; it does cost us some money, so it takes some labor. But we have done that on every project that we have acquired, and it's a benefit to our investors and us to be able to take some accelerated depreciation. So you can see the example. We've now taken the same building, and now we put in a few more buckets. You can see the building; it's 1.495. That's the raw building there. The personal property. The personal property now is things like I described earlier: fixtures, vanities, cabinets, carpet, things that will wear out over time. They have a specific schedule and says that's worth about 500,000 of this $2 million building. Land improvements, parking lot, play areas, fencing. Again, that's another component. And again, the land. So now we've taken it and added basically a couple more buckets. Now what do we do with it? Now we're going to be able to move some of these 5-year items. And again, if I took 500,000 divided by 5, that's a much larger number than 500,000 by 27, right? So again, we're capturing more in a shorter period of time. What bonus allows us to do is it allows us to take those items and take it all in year 1, which is pretty exciting. So if you invest in a project, let's say in 2024, you'd be able to capture the majority of those. Now, I didn't mention, right, there's a little bit of a caveat. I did mention that this bill, this particular component is stepping down. So today it's at 60%. So you're going to see in my example, I use a year 1 loss there. But let's focus on the top here if I jump too far ahead.
Mike, we do have our first question.
Sure.
And you could have probably seen this one coming, but Rose is asking, what about recapture at sale?
Yep. Yep. So we're going to think about the future and paying taxes in the future down the road, Rose. But yes, there is a recapture component. The longer you hold it, the less recapture you have. But there is recapture. So the government gives us this tax break, but then they want to get repaid for it, right? Because basically we're kicking the can down the road. So I don't have recapture listed in this because it's a pretty hairy conversation as far as how you calculate recapture, but it is there. It does have caps though, and so it's not as scary as it sounds. So the benefit that you get still outweighs the cost at the end. So just something to consider there. But I'll talk through it a little bit at the end there, Rose. So thanks for the question. Let's go back up to the top though. Again, remember we purchased this for 2.9 million. We're going to finance a little over 2 million. We have to come up with some capital for the improvements, closing costs, all that kind of good stuff. That's 1.2 million. So that's the equity that we're going to raise. So if this was a live project, this is exactly what we do. It's about 40% of the purchase price. You guys kind of follow with me up top. Now, with the way these improvements are, we're able to now capture different buckets of losses. So if you look at the example there, I took the 1.49 million, that's the building value. I'm going to divide that by 27 years. That's $54,000. Then I'm able to take 100% of the personal property. That's that 500,000. I can take 100% of the 75,000, add those together with my 54. In year 1, I can take a $629,000 loss, right, in operations essentially off my net income. And we pass that along to the limited partner. So we basically do the math, take 629, divide that by 1.2 million. That's 52%, excuse me, of your investment that you would be able to write off. So if Rose came in and invested 100,000 with us, she would get a K1 tax form from our CPA that would show a negative 50,000 in that first year. If this was back in 2022, because remember, I did say it's expiring and it's on its way out today. So this is going back 2 years, 2022. Today it's at 60%. This was at 100. And so basically you would just cut down your amount that you can depreciate by 20% per year. So you're still going to get a benefit, but this is the large benefit. Now, what got everybody here was we were talking about cash flows. Let's use that $100,000 again. You're going to earn 7%, $7,000. Well, if you have a loss sitting for 50,000, right? That's in your depreciation bucket. It's in your back pocket. You can use it when it's applicable. If you get a distribution from us for 7,000, well, you can use that 50K or a chunk of it to be able to basically offset your tax bill, right? That's a huge piece. So you can use it now over the course of 4 or 5 years, or you can save it to the end and use it at the end, or you can not use it at all. Just totally completely up to you. That's really the benefit. And everyone's scenario is just a little bit different. Now, who can use all these, right? We just described it. Who can use it and how can you use it? So for most folks, you're going to have, we just kind of described at the top there, active gains and passive gains. So for most investors, you're typically already have a W-2 or you're employed, gainfully employed. And so you're going to have those active gains. Now you can take active losses against active gains, right? So active losses are your typical standard depreciation the IRS gives you, your mortgage interest, your donations, all that kind of good stuff. It's not very lucrative. And I didn't get to say this yesterday. I did this webinar yesterday. The tax code is written for investors. It's written for entrepreneurs. It is the most detrimental to 90% of the US citizens that have W-2 jobs. If you are a high W-2 earner, you get little to no tax benefit. So why am I saying that? Find investments that allow you to use some of your hard-earned capital and find another way to manage the income so you don't have to pay as much taxes on those investments. That's where you become passive. So if you go to the passive side, you're going to have gains. So if you sell an investment property, if you have rental income on other types of single family real estate, maybe that's passive gains. And so you can take the depreciation that we're talking about and use it against some of those gains. Or again, you could sit on it and you can use it later when you have a large sale, for example. It doesn't go away. It's tied to your EIN or social security number. And so all of this to say, find a good CPA that knows real estate. There are hundreds of thousands of CPAs out there. Many of them do not understand the way the tax code works around real estate. And I think it's the biggest secret. Knowing the code, knowing the rules, it applies to everybody, but a lot of folks just don't know what you can do. There are loopholes. Yeah, there are loopholes. If you have a W-2 and you're looking for some additional gains or additional losses, short-term rentals is another tool. We won't get into it, but again, there's lots of good stuff out there. So go ahead, Michael.
Really quick, how would this apply, for example, if somebody had a significant capital gain from, let's say, selling stock?
Great question. So a stock gain, typically less than 1 year, is considered active. And so they wouldn't be able to take a passive loss like what we're offering and be able to apply it to the active side. That's why I created these kind of 4 areas. So active gains with active losses, passive gains with passive losses. Now, let me go to the next screen because that could answer the question. This is something that, again, we're not going to get fully into, but it is an opportunity for some of you. If you have again, high earning W-2 and you have a spouse that is, you guys filed jointly, there's an opportunity to take advantage of what they call real estate professional status or REPS status. What that allows you to do, one, you have to be an active investor. And these are all the rules. I'm not going to get into all of these, but you guys can read through these. There's material participation. There's a lot of tests that you must pass in order to get this status. Again, a CPA that you work with that knows real estate can help you qualify for this. If you can do that, one of you can take the passive losses that I just described. The other person has a W-2 that has active gains, that has active real estate gains or stock gains, and be able to offset the passive and active. This is the only scenario where that's possible. If you have a W-2 and you want to be a professional real estate professional, can't happen. The reason it can't happen is because you have to materially participate more than 50% of your time. So 51% of your time. So if you're working 2,000 plus hours in another job, there's no way the IRS will say, well, you can't do that and do this. You can only do one. So typically it's why I say a married couple or a couple filing jointly can find a way to do that. And it's a great way to work through that. So, Michael, I hope I answered that question.
Yep. So just really quick then, what about stock capital gains over 1 year?
Long-term capital gains. As far again, not a CPA, but as far as I understand, it is still an active gain, and so it may not qualify. But check with your CPA. I've heard different stories on how they can categorize that. Matter of fact, we might have had some investors that had large long-term cap gains and were able to use passive losses from real estate to offset them. But again, every person's scenario is different, so not giving tax advice. Good question. All right, what if I don't use it? So we talked about this, right? If you get it in year one, you have this K1, it's attached to your social security number. You don't have to use it. You may not have anything to be able to capture. You may be 2 years from now, 3 years from now. Eventually, if you partnered with us, we're going to sell that property and you are going to have a large gain, right? So if you put 100K in, our typical returns project a doubling of your income or your investment. So you put 100K in, our goal is to get you 200 out. Some part of that will be cash flow and some part of that, large part of that will be equity. Well, those depreciations have been, basically banked for the last 5 years. And now that gain could be potentially fully sheltered. Now, I remember going back, Rose talked about recapture. It is some percentage of that will go away. But again, there's a very good chance, even with recapture, that you will likely not have to pay taxes on those gains. And remember, you're going to still get your 100K back that you put in the first time. So that 100K, that's your principal. You don't pay taxes on that. It's only on the gains. So you have gains from cash flow, and then you have gains from equity. But again, if you structure it right and you talk to the right CPA, there's a very good chance that you don't have to basically ever pay taxes on those gains. So that's why real estate investing is so awesome. And that's why we do it full time. So I talked quickly about it going away. This is the chart that kind of describes it. So the example I gave everybody earlier on was 100%. So that means we could do that full 100% pull out of depreciation, bonus depreciation. In that example, that 100% was $600,000, 629. And you can see that right up here. And as an investor, again, let's say Michael came in with 1.2 million, he would get a 52% K1 loss, right? About 52% of his investment. 23, 24, so 24 this calendar year, it's about 30%. That's still substantial, right? It's far more than the cash flows you're going to earn, which is really a big piece of it. And you'll have some left over. And again, this is year one. In year 2, 3, 4, and 5, we still have traditional straight line depreciation. So you're still going to get a K1. It's not going to be as big. But again, if you haven't used it, all of that banks and grows. So, and today it's going to phase out in 2026. That is under the current administration. As Mr. Trump comes back in, this was something he was very bullish about. As most of you know, he's a real estate developer, and they are looking to likely bring this piece back along with the other benefits that are in that act. And the Tax Act, folks, I'm talking about real estate here, but there are some substantial rules that are set to expire. One of the changes is the marginal tax rate. So he brought it down. I want to